dear students, to the massive open online course on money and financial markets. In today's module, we are going to talk about interest rates in India. The main objective of this module are to understand the interest rate system and the system of administered interest rates in India. We would also try to explore the process of the deregulation of interest rates, and we would try to identify the features of the current interest rate systems and the interest rate trends in India. We all know that interest rate is a price of instruments available in the financial markets. It is basically a major channel for the monetary transmission mechanism. If we look closely at the interest rate system in India, we can divide the period since 1951 to the present day into 5 different phases of interest rate system in India. Now, phase 1 basically covers a period of 10 years, that is from 1951-52 to 1960-61, and we call it basically the flexible interest rate system. Phase 2 starts from 1961-62 and covers till 1985-86. This is the system of administered, regulated, and repressed or suppressed, rather a very low interest rate regime. Phase 3 is a period from 1986-87 to 1990-91, which is basically the beginning of liberalization or a semi-administered system with slowly the inching up of interest rates. Phase 4 is a period from 1991-92 to 1996-97, wherein we have the system of progressive deregulation and flexibility and a significant increase in the interest rates. Rather, we can call it the phase of deregulation and dear money. Phase 5 is from a period of around 1997-98 to roughly 2015-16. We can also extend it to the present year. It is a system of managed flexibility and nearly complete deregulation and one of the lowest levels of interest rates in India. So we can also in short call it the phase of deregulation and cheap money. Now we focus on the phase 2, that is the administered interest rate regime. Till about phase 1, that is till about around 1958, all the interest rates were more or less free. In the month of October of 1958, that year, however, a ceiling on the deposit rates of commercial banks was introduced through the voluntary agreement between some Indian and foreign banks. Under this agreement, a separate maximum rate was fixed for deposits of different maturities. Even then, there was a great deal of flexibility and variations in the deposit rates paid by different banks which were party to the agreement. The rates paid by the other banks naturally differed from one another and from the banks bound by the agreement. And this system basically lasted for around 6 years. In September 1964, it was replaced by the regulation of the deposit rates by the RBI in terms of the Banking Regulation Act of 1949. With this change, the system of regulation became more general and it involved, unlike previously, the fixation of both the minimum and the maximum rates. Under this system, while the maximum rate is prescribed on deposits of maturities up to 90 days, the minimum rate was prescribed on deposits of maturities beyond 90 days. Now, if we talk about the cooperative banks, we find that the deposit rates of the cooperative banks came under the purview of these regulatory measures. but not until 1974. So till 1974, the deposit rates of cooperative banks were free and flexible. From 1974 onwards, the cooperative banks also have been paying on the deposit interest rates prescribed by the RBI. They are now allowed to pay interest rates which are higher by certain percentage points, normally 1/2 of 1%, over the rates prescribed for the respective maturity deposits of commercial banks. As a result of this policy, interest rates of commercial and cooperative banks came to be linked, and changes in them have been effected simultaneously since 1974. The lending rates of the commercial banks have also been controlled by the RBI in terms of the Banking Regulation Act of 1949 since 1960 in the form of prescribing minimum, maximum, dual and differential interest rates. So we can say, if we look closely at the whole regime of the administered interest rate, we see that the lending rates of the cooperative banks were regulated indirectly or through suasion till 1980. As the cooperative banks at all levels of their three-tier structure depend on the RBI for concessional financial resources, while they were always expected to charge only reasonable rates to the borrowers from the agricultural and the allied activities, in case of finance for production and marketing activities of the cottage and the small-scale industries, the terms of concessional refinance stipulated certain conditions about the rates to be charged by them to those borrowers. So in 1980, the loan rates of the cooperative banks also came to be statutorily regulated by the RBI. Coming to the interest rates on deposits, which were accepted by the non-banking, non-financial companies and non-banking financial and miscellaneous companies, which were completely free till the period of 1980s, have become subject to a ceiling fixed by the Government of India and the RBI respectively, with effect from the beginning of the financial year of 1981-82. The Controller of Capital Issues fixed the ceiling on the coupon rates on industrial debentures and preference shares. The Indian Banks Association had been fixing the ceiling on the call rates since 1973 until October 1988. The government fixed the rates on the treasury bills and long-term government securities. The RBI fixed different interest rates on loans to different categories of borrowers and on loans for different purposes. So, students, I ask a question to you now. Why had the authorities imposed control on the interest rates? So, we saw that in phase 2, there was a regulation of the interest rates. Now, we need to really understand what were the reasons for the regulation of interest rates. Now, why do we think that an economy would really want to have a low interest rate regime? Here we are talking about the Indian economy from the time period 1950-51 to around 1960-61. This is a time period of the first two plan periods, that's first 5-year plan and the second 5-year plan, where the Government of India and the policymakers had tried to embark upon a planning process which required lots of financial resources, where the government was more interested in bringing about investment projects and more investments on the part of the government. So, a low interest rate regime was necessary in order to induce a high rate of capital formation in the economy. Now, a high rate of capital formation is critically important for economic development of the Indian economy at that point of time. So, we find that according to the Keynesian idea, a low interest rate is assumed to foster investment in the economy. So investment, since it is inversely proportional to the rate of interest, so if we have low rates of interest in the economy, investment naturally will be high. And in the Keynesian era that was prevalent at that time, it was really very much unfashionable to advocate a high rate of interest. If we look at all the developed economies at that period of time, during that period in the 50s and 60s, we find that in almost all the economies, apart from Germany, the interest rates were traditionally and fashionably very low. And if Indian policymakers would have advocated a much higher interest rates, it would seem to be singled out as a country which is less advanced and not in the elitist club. So the policymakers wanted to put India, showcase themselves to be in league with the developed economies. So they went with the low interest rate regime that was prevalent in the Indian economy at that point of time. Another thing that has to be kept in our mind is that Indian economy is basically characterized by scarce capital and abundant labor. So whenever there is abundance of labor, it reflects low level of wages. So abundant labor basically leads to low level of wages, which in turn leads to low level of labor productivity in the country. At the same time, since it is a capital scarce country, then the price of capital should have been high. But since there was lack of capital investment in the economy, that is lower mechanization in the economy, so we found labor productivity to be low, and at the same time, though it was a capital scarce country, the price of capital was not high. It was also low because the policymakers had, they had forcibly kept the interest rate low. So capital scarcity was not recognized in the price offered for capital. It was kept exceedingly low. Thirdly, the type of planned economy that India was following, the government and the public sector, both of them had huge financial requirements. If interest rates were kept low and stable, the cost of public debt would also be kept low, and the stability would be maintained in the government securities market. So this was also another very important reason for keeping the interest rates low in the economy. Now, when we talk about this administered interest rate system, do you think that it was bereft of any sort of deficiencies? Of course, it did have some deficiencies, because such unduly complex system do reduce the ability of the monetary system to promote the effective use of credit in the economy. On top of it, the low yield on treasury bills and the government securities, this resulted in a high level of monetization of the public debt. And also, since public debt was highly monetized, there was consequent a high amount of monetary expansion that took place in the economy. If we look at the capital market for government securities, we find that market was also captive, and it also adversely affected the growth of the capital market and also the profitability of the banks. Then the concessional rates of interest that really led to projects of quite doubtful validity to be undertaken. That means projects were not taken up on merit just because interest rates were available at concessional rates. Any type or any quality of projects were undertaken, and they did have some sort of quote-unquote doubts associated with them. Quantitative credit controls had also come under severe stress in the absence of support from any price rationing mechanism. And we find that the total administered rate system lacked the flexibility that was necessary for augmenting the pool of financial savings in the economy. Slowly from phase 2, and as we moved on to phase 3, we find a slowly deregulation of the interest rate structure taking place. So we need to really understand this process of the deregulation of the interest rate structure. The process of this deregulation of the deposit interest rates began in the 1980s. Around April 1985, banks were allowed to set interest rates for maturities between 15 days and up to 1 year, subject to a ceiling of around 8%. It was expected that with reasonable interest rates on maturities, banks would be able to achieve a better distribution of term deposits rather than highly skewed distribution around longer maturities at relatively higher costs. Now, here, a type of pandemonium was noticed because when a few banks started offering the ceiling rate of 8% even for maturities of 15 days, other banks also followed suit without regard to consideration of profitability, and they also set a single rate of 8% for maturities starting from around 15 days and up to 1 year. So what was the consequence? The consequence was a shift of deposits from the current account and to a lesser extent from the savings account to 15-day deposits. And what ensued was price war between the banks. And this freedom to set interest rate subject to a ceiling of around 8% that the RBI had postulated was withdrawn in May 1985 because of this type of price war and, as I said, the pandemonium and the competition between the banks. So, in May 1985, this process was stalled, but again, this process of deregulation resumed itself in April 92 when the existing maturity-wise prescriptions were replaced by a single ceiling rate of around 13% for all deposits above 46 days. 1994, November 1994, the ceiling rate was brought down back to around 10%, but again in 1995, the following year, it was raised to around 12%. Banks was allowed to fix the interest rates on deposits with maturity of over 2 years in October 1995, and this was further relaxed to maturity over 1 year in the very next year, that is in July 1996. In October 1997, the deposit rates were again fully deregulated by removing any sort of linkages with the bank rate. So, what basically the consequence was that the RBI gave total freedom to the commercial banks to fix their own interest rates on domestic term deposits of various maturities with the prior approval of their respective board of directors or asset liability management committees, which we call ALCO. The banks were permitted to determine their own penal interest rates for premature withdrawal of domestic term deposits. So if there was any customers who were prematurely withdrawing their domestic term deposits, the type of penalty interest rates that was to be paid by them to the banks were free to determine their own penal interest rates. And also the restrictions on the banks that they must offer the same rate on deposits of the same maturity irrespective of the size of the deposits was removed in respect of deposits of 15 lakhs and above in April 1998. So basically, the RBI had started to give banks more freedom with respect to what they can do with the deposit rates. So now, after 1998, banks had complete freedom in fixing their domestic deposit rates except interest rates on the savings deposits, which still continued to be regulated by the RBI. In 2009-2010, the RBI made an announcement in their annual policy statement. They advised the scheduled commercial banks to pay interest on saving banks account on a daily product basis with effect from 1st April 2010. This was very important. Previously, it was not paid on a daily product basis, but then the RBI directed the commercial banks to do so with respect to the savings bank accounts. As I said, prior to the introduction of the daily product method, the interest on the savings deposit account was calculated based on the minimum balance maintained in the account between the 10th day and the last day of each calendar month and credited to the depositor's account only when the interest due was at least 1 rupee or more than that. After the change, the effective interest rate on the savings bank deposits increased. Thereby, obviously, the depositors got much benefited by this new method of savings bank deposits. We now go to try to explore the trends in the interest rates in India. In the Indian context, movement in the real interest rate was not a major concern, as long as the interest rates were highly regulated and the resource allocation was largely determined by the planned framework of the Indian economy. After 1991, with the economic reforms in place, especially when reforms in the financial and the monetary sectors were introduced, which encompassed the deregulation of the interest rates, there has naturally been heightened concern about the movements in the interest rates. So, as you are by now aware that the interest rates in the market nowadays, in the Indian economy nowadays, are largely determined by the market forces. Now, RBI's monetary policy had been mostly focused on short-term liquidity management. Up to 2009 to 2010, RBI only used repo rate and reverse repo rate as the major policy interests. So the repo rate and the reverse repo rate were the main instruments of control of the RBI, rather the anchor instruments, while bank rate was almost stagnant at around 6%. Since 2010-11, RBI even stopped using the reverse repo rate. It started to use only the repo rate as the policy rate, because ultimately the reverse repo rate and the bank rate were also dependent only on the repo rates. The trend shows that repo rate had varied between 7.3 and 8% during 2010-11 to 2014-15 and came down to around 6.7% in 2015-16. Now, if we look at the recent years, I mean, we all know that from 2020 onwards, the whole world had been undergoing or reeling under the shocks of COVID-19, of the pandemic. So, in view of the COVID-19 pandemic, the Monetary Policy Committee decided to vote for a sizable reduction in the policy repo rate, and they wanted to maintain an accommodative stance of monetary policy as long as necessary, so that growth could be revived and all the adverse impact of the COVID-19 pandemic could be mitigated. And at the same time, they also wanted to ensure that inflation also remains within the target. So the MPC basically voted to reduce the policy rate, that is a repo rate, by around 75 basis points to around 4.4%. So thus, almost while we try to conclude this interest rate system in India, we find that every interest rate in India is now was very closely administered in the form of fixation of either the specific or minimum or maximum, that is a ceiling, or dual or differential level by the government or the RBI or the controller of capital issues or the Indian Bank Association, etc., through the exercise of statutory powers or voluntary agreements or suasions during the administered rate regime, that is during the period of phase 2. After that, when we had economic reforms in place, India did pursue the financial sector reforms as part of the structural reforms that were initiated in the phase of 1991 and aftermath. And a major component of the financial sector reform process was the deregulation of a complex structure of deposit and the lending interest rates. So the administered interest rate structure proved to be inefficient. It therefore became necessary to reform the interest rate structure in India. So the deregulation of the interest rates were intended to strengthen the competitive forces, improve the allocative efficiency of resources, and strengthen the transmission of monetary policy in the Indian economy. Thus, the process of deregulation of interest rates, which essentially began in the early 1990s, was largely completed by 1997. And at this present moment, we can say that we are basically in a regime of totally deregulated interest rate, but with cheap money.